You ever look at a company's financial report and just think, wow, that looks perfect? Well, you know what they say. Sometimes things are a little too perfect. Today, we're putting on our detective hats to uncover the accounting tricks that companies use to cook up that flawless statement of cash flows. So, grab your magnifying glass, because we are about to dive deep into the financial sleight of hand that can make or break a company.
So, to get our heads around this, we actually need to talk about the 1988 movie Twins. Yeah, you heard me right. Remember the whole idea? This secret experiment funnels all the desirable genetic traits into one perfect kid, Arnold Schwarzenegger, while all the leftover genetic trash goes to his, less than perfect twin, Danny DeVito. Well, it seems like some corporate execs were taking notes. They do the exact same thing with their cash flow statements. They funnel all the good, strong, desirable cash into the super important operating section, and they try to hide all the unwanted stuff somewhere else.
All right, here's the game plan for today. First, we'll break down the Twins trick itself. Then, we're going to look at the evidence from 3 major shenanigans the companies use to pull this off. And finally, we'll pack you a bag with your very own investor detective kit. Okay, let's really dig into this Twins cash flow trick. It's all about financial genetic engineering. The whole point is to create a financial statement that looks way stronger, way healthier, and way more attractive to you, the investor, even if the reality under the surface is, well, a lot weaker.
So the goal here is pretty simple and honestly pretty deceptive. You take cash that really comes from a financing activity, think getting a loan, and you mislabel it so it looks like it came from the operating section. And why would they do that? Because strong cash flow from operations, or CFFO, makes a company look like an absolute cash-generating machine. It's the financial version of creating Arnold Schwarzenegger.
All right, our first case file, this one involves the auto parts supplier Delphi Corporation. And this, my friends, is a textbook example of creating cash flow out of thin air with a totally bogus transaction.
So get this, it's the end of 2000. Delphi is under a ton of pressure. They are staring down the barrel of a really bad quarter with seriously negative cash flow. That would have been a disaster for them. So, what do you think they did?
Well, they got creative. On paper, Delphi sold $200 million worth of inventory to its bank. But here's the kicker. They had a secret backroom deal to buy it all back just a few weeks later, and at a higher price. This wasn't a sale at all. It was a short-term loan dressed up to look like one. And just like that, they magically booked that $200 million as cash from operations.
And wow, the impact was just staggering. I mean, look at these numbers. They reported a positive $42 million in operating cash flow. But once you pull back the curtain on that phony $200 million loan, you see the grim reality. A miserable negative $158 million. This one single trick completely flipped their entire financial picture for the year. Unbelievable.
So the Delphi case gives us our first major detective tip. If you ever see signs of sketchy revenue, like Delphi's fake sale, alarm bells should be going off in your head. Because where there's smoke from bogus revenue, there's almost always a fire raging in the cash flow statement.
All right, let's move on to our second shenanigan. This one's a little trickier, because a lot of the time it's a completely legal practice. It's called selling receivables, and it's basically a way for companies to time travel, pulling cash from the future into today. So what does this even mean? Okay, imagine a company has a bunch of invoices out to customers that are going to get paid in 30 or 60 days. Those future payments are called accounts receivable. Now, instead of just waiting, the company can sell those invoices to a bank, get the cash right now, and, you guessed it, that cash gets classified as an operating inflow. It's a legitimate tool, for sure, but it can be used to create this illusion of insane but totally unsustainable growth.
Okay, take a look at this chart. In 2004, Cardinal Health reported this absolutely stellar growth in their operating cash flow. I mean, it nearly tripled in just 1 year. If you were an investor, you'd look at this and think, wow, their core business must be on fire. But, as we're about to find out, not all growth is what it seems. Because it was completely unsustainable. They were basically just robbing their future selves to make the present look amazing.
And here is exactly how they pulled it off. So their total operating cash flow went up by about $971 million. But just look at the line item for receivables. It swung from a negative $488 million outflow to a positive $622 million inflow. That's a total swing of over $1.1 billion. That massive swing, driven entirely by selling receivables, accounted for all of their reported growth and then some. This wasn't an improvement in their business at all. It was a financing trick.
And now we move into the darkest territory of all,
This is where companies don't just use a legal tool to mislead you, they commit straight-up fraud by faking the sale of receivables. And usually, it's to cover up an even bigger crime.
Meet Peregrine Systems, a company that was basically a house of cards just waiting to tumble. First, they spent years recording bogus revenue. This created a huge problem for them, a mountain of fake invoices on their books that were never, ever going to get paid. So to hide this massive smoking gun, they started another fire. They pretended to sell these worthless receivables to a bank.
So how in the world could an investor have spotted this? Well, the clues were actually hiding in plain sight, in a section that, let's be honest, most of us just skip over: the risk factors. It looks like boring legal jargon, but as you're about to see, tiny little changes in this section can signal massive, massive problems.
And here it is, the first clue, buried in a filing from June 2001. Peregrine added this new language, admitting that 1, they were doing more customer financing, and 2, and this is the important part, the customers were failing to pay them back. For a sharp-eyed detective, this was the first subtle tremor before the earthquake. And then, just 6 months later, came the smoking gun. This tiny 12-word sentence, buried deep in a filing. The company may at times market certain client receivable balances. Bam! That was the confirmation. They weren't just financing customers anymore. They were now actively trying to unload those bad debts. It was the final piece of the puzzle that showed the cover-up was officially on.
Okay, we've examined the crime scenes. We've seen the evidence. Now, let's put together your toolkit so you can be the detective. What are the practical, real-world red flags you should be looking for? First, always be skeptical of weird, made-up cash flow metrics. Companies love to invent their own pro forma numbers to look better, so stick to the official standards. Second, just like we saw with Cardinal Health, question any sudden, massive swings in things like receivables. It might mean they're just pulling cash out of a hat labeled the future. Third, seriously, read the risk factors. Peregrine showed us that tiny changes there can be a huge deal. Fourth, if a disclosure about some financing deal is confusing or vague, get suspicious. Transparency doesn't need to be complicated. And finally, do some digging. See if the risk of non-payment was actually transferred. If the company is still on the hook, if a customer flakes, it's not a real sale, it's just a loan in disguise.
So, the next time you see a company with a perfect Arnold Schwarzenegger-esque cash flow statement, you'll know exactly what to do. The only question is, are you ready to look past that perfect exterior and find the Danny DeVito they tried to hide in the financing section?